To sum it up, 2008 was a stable year with modest absorption and cautious new construction. As you can see, St. Louis fared well with nearly 800,000 square feet of positive absorption, with Class A and B vacancy at 11.7%, down from 12% in 2007. Although 2008's absorption is down from the 1.1 million square feet average over the prior 3 years, much of the decline is attributable to the lack of large blocks of contiguous space and the little new construction. So let's take a look at a few of our selected submarkets. West County, most notably our largest market with nearly 17 million square feet, accounted for nearly half of the metro area's total absorption at 383,000 square feet, with Class A and B vacancy at 9% and Class A as low as 6%. Clayton, one of our tightest markets, which boasts the area's highest rental rates, recorded a healthy 118,000 square feet, and unfortunately, the flight out of downtown continued in 2008 with a negative 114,000 square feet. So let's take a look at what accounted for some of this absorption. Of the major transactions shown in 2008, ranging from 50 to over 250,000 square feet, it is very important to note that of the 1.1 million square feet shown, over half was true net absorption to the marketplace. So where did some of these companies go? In 2008, companies were forced to look at new construction. Of the 2008 spec construction totaling over 300,000 square feet, all three buildings initiated as a spec collectively were 88% leased prior to completion. Other notable construction in 2008, the build-to-suit projects, totaling over 400,000 square feet, all 100% leased. In fact, the last 6 buildings you saw totaling over 700,000 square feet delivered in 2008, a mere 6.6% remains vacant today in 2009. So what's currently under construction right now moving into 2009? The spec construction, the Meridian, 2009 spec construction, Meridian and Progress Point currently are 30% leased. However, it is rumored that Progress Point has 1, maybe 2 tenants interested in occupying the entire building, bringing its occupancy up to 100%, which would collectively bring these 2 buildings to 71%. Also in 2009, the build-to-suit projects. Lakeside Crossing, built for Monsanto, their second building in that area, as well as Highlands Plaza 2, developed for Renaissance Financial and Cordy Construction, currently 98% leased. So that's a quick, brief overview of 2008. Let's talk a little bit about 2009.
So here's a question we keep getting from lenders, attorneys, tenants, landlords. How bad can it be out there? How bad is it going to get? You guys got to be getting killed, right? Remember this headline from December of 2007? Investors were so afraid that they were willing to take a 0% return to find a safe place to park their money. Can the St. Louis office market get this bad? No, we're convinced that it's much healthier than that. In order to prove that case, we need to look back at previous recessions. We're going to start with the recession of the 1990s. Gordon Gekko, the go-go 80s. St. Louis, like much of the country, was going through an economic boom, and developers were adding inventory at an unprecedented pace. As a matter of fact, for those of us that weren't involved in the commercial real estate industry, much of this development took place along the Highway 40 corridor. It was highly speculative in nature. Buildings were popping up overnight. Now here's the problem. Anytime there's a boom, there's a bust. So we decided to look at a 3-year period, 1 year prior to the recession and 2 years of the recession, to see how much inventory was added compared to demand. Here's what we found. During this 3-year period, 4 million square feet of new inventory hit the market just in that 3 years. But demand began to taper off. Demand was only 2.6 million square feet, leaving a surplus inventory of 1.4 million square feet that needed to be absorbed. Now that wasn't the only problem. You take that and combine it with all that was added in the mid-'80s, well, we didn't know at the time, but what we had was a 7-year supply of office inventory sitting on the market. It wasn't until our next big boom, fueled by our friends in the telco and .com industry, that development began again in St. Louis.
So it took nearly 7 years to rebound from this last recession before hitting a vacancy low of 7.2% throughout the metro area. With absorption strong, vacancy rates decreasing, and rental rates increasing, developers sensed that new construction would be met by the previous year's demands. So construction began, all the way up until the tech wreck, or the dot-com era. So let's take a look at the 3-year period from 2000 through 2002, 1 year before the recession, 2 years during the recession. Much of this construction was already underway, but during this 3-year period, 5.1 million square feet of new supply was added to the marketplace. However, similar to what Jim just mentioned in the last recession, demand tapered off. 1.8 million square feet of space was absorbed. In fact, of this 1.8 in 2002, St. Louis actually recorded a negative 180,000 square feet of absorption. So what does this mean? Well, it means we've got a 3.3 million square feet oversupply of space. In addition to this, at the end of 2002, 1.2 million square feet of sublease space was available on the market, bringing the overall St. Louis vacancy rate to a high of 17.2%. How does this recession compare to these prior 2 recessions?
Well, according to most economists, the recession started in December of 2007. So we decided to take a look back at 2006, 2007, 2008, and make the same comparison. Something interesting came about here. Look at what happened in this 3-year period. New inventory was 2 million square feet, but demand actually outpaced it, 3.3 million square feet. This is very important. Let's compare these 3. Let's take a look. Early 90s, oversupply. Early 2000s, significant oversupply coming to the market. But in this 3-year period, demand actually outpaced supply. This is a very healthy sign as we move forward into this recession. Now, I know the question you're going to ask, why didn't we see more development? There's several factors. Let's start with developable sites. Remember that 40 corridor we talked about earlier? Today, there are only 2 zoned developable sites with direct Highway 40 visibility available for construction, just 2. How about high cost of construction? Since 2000, construction costs are up significantly. Let's look at 3 different buildings in 3 different trade markets, starting with a LEED certified building in St. Charles, a new construction building on the 40 corridor, and a new construction building in Clayton. Look at the differences in these costs for construction, but more importantly, look at the required rental rates that a developer would need to achieve in order to make their returns. There's no doubt the high cost of construction put a damper on development over the past 3 years. Now, we all know about the credit markets. We all know they're locked up. That's not just something that happened in 2008. This actually started taking place in 2007. Underwriters were requiring more equity, more pre-leasing, and more stringent guidelines. Now, there is one good thing that came out of this credit crisis. It did cause the developers to show some restraint, although it wasn't self-restraint. Now, let's look at the companies that are fueling the industry today. This is vastly different than we had before. Let's start with the healthcare industries. Centene, Express Scripts, BJC, each one of these companies is actively adding to their office inventory as we speak and growing in this recession. I got a question for you. Other than New York City, which city has the highest concentration of financial headquarters? Boston, Chicago, San Francisco? No. St. Louis, home to 4 financial institutions, Wachovia Securities, Stifel Nicolaus, Edward Jones, and Scottrade. Here's the interesting to note about these companies, though. Most of them did not get caught up in those exotic derivatives that brought down the big boys from Wall Street. And 3 of the 4 of these companies are either adding or have added to their office inventory. Lastly, Monsanto Corporation. How about this thing? They had their record sales in fiscal 2008 and over $1 billion of additional profit in 2008 compared to 2007. This is under an economy that most people think is the worst since the Great Depression.